I look at the turmoil out there in equities, and I want you to bring it right away over to the bond market. Are you clipping coupons? Do you have the scissors out? Does Larry have you in the basement and you got the scissors out clipping coupons? Or can you actually manage and execute total return in bonds this year?
Right. Thanks, Tom. It's great to be here with all of you. We absolutely see a really attractive opportunity in fixed income. I think Lisa, though, suggested earlier in the program, there's a bifurcation between the haves and the have-nots, and that's absolutely something that we're focusing on in the corporate credit market. I think one of the really interesting points is adjusting to this higher cost of capital environment. And so from our perspective, the disruption in the regional banking system, the pullback in credit that we expect is going to have different implications for different parts of corporate credit. Taking the U.S. leveraged loan market, for example, we've seen a doubling of interest costs in 4 quarters. And so that's really something that I think we're paying a lot of attention to. Now, for asset allocators, you are actually getting paid a lot more for that risk. You're picking up around 200 basis points if you looked at single B loans versus single B high yield bonds. So there is a real relative value dislocation that you have to manage there. But that's really what we're watching going forward. I think the 2 things that are really important is that even a period of just below trend growth in a higher cost of capital environment should warrant a rebuild of risk premia in corporate credit. And then the second thing is, unlike the period of the past 2 decades, we are actually seeing some differences in the way that stress is manifesting. So, for example, we're seeing the loan default rate outpace the high yield bond default rate, which is something that hasn't happened for most of the past 2 decades. We think that will continue. We think that there will be differentiation between sectors as even some of these corporate companies and sectors have to refinance into a higher cost of capital environment, say in the high yield bond market. So while we absolutely see an opportunity in fixed income, it's really important to tread carefully. We're paying a lot of attention to sector allocations, parts of the curve. And ironically, as Lisa, I'm sure you well know, high yield has actually outperformed IG so far year to date. So for all of the concern about downside risks to growth, we actually haven't seen that manifest in the lower quality parts of the market.